Inflation is high, you name it. Energy, food, housing, all sorts of products have seen a rapid increase in their price. But why is this the case? It wasn't that long ago that some developed economies would have welcomed some more inflation, as they would have been able to raise their interest rates from their shockingly low number. Yeah, I'm looking at you, those in the euro area. Anyway, when are inflation rates going to chill? And what are the predictions for the future? Hi, welcome to Economics in Action. If you like this kind of content, then subscribe to support the channel. Anyway, on with the video. Okay, so we're primarily looking at developed economies in this video. So the usual crew, North America and Europe. Yeah, sorry Japan. It turns out that things have to get really bad just for you to experience some normal levels of inflation. Anyway, the current inflation rate being witnessed is being caused by multiple factors, which is why it is so freaking high. So let's break them down. 1. Supply chain shocks. You remember COVID? Yeah, well, its impact still hasn't left the global economy yet. The roaring demand from the reopening of European and North American economies has outpaced the ability for supply chains to adjust their supply. And well, increased demand and a slower recovery of supply capabilities means prices go up. This has been apparent with commodities like lumber and semiconductor chips. 2. QE. QE, or quantitative easing. It's been around for 2 decades now, and during COVID, some central banks exercised their ability to purchase government and corporate bonds, do QE. This isn't literally printing money, but it sure does expand the money supply. And it has been known to expand economic activity and reassure investor confidence in financial institutions, while also sending asset prices to the moon and supporting overall inflation in the economy. At the uncertain time that was the beginning of COVID, this may have seemed like the best plan of action a central bank could take. However, now with inflation running high, it's fair to say no central bank is running a QE program with the objective of increasing the rate of inflation. Nonetheless, QE programs enacted during the COVID pandemic have contributed towards the current level of inflation and are therefore, in part, responsible. 3. Energy. It may seem like a far distant memory, but energy wasn't that expensive in the not-so-distant past. Remember when oil had a negative price in the market, and I assume a good couple of thousand of people Googled how to purchase some barrels of the stuff and store it in their homes. Well, now, oil and gas prices have been shaking the global economy for 2 reasons. 1, in part because of those supply chain shocks, readapting to demand, and 2, because of Russia's invasion of Ukraine. But remember, energy is important for transporting goods and making sure companies can provide their services. So, an increase in energy prices is felt in every business, all parts of the economy, and as a result, it has a strong impact on inflation. 4. Russia's invasion of Ukraine. Hey, it's everyone's favorite topic these days. War is horrific, and one of its byproducts of this war has been inflation. Russia is a key player in the global energy market, and both Ukraine and Russia are key players in the global agricultural markets. With both countries experiencing significant economic hardship due to the war, this means energy and foods have seen reduced supply to global markets, resulting in additional pressures on inflation across the globe. So, in short, things are not cool. People around the world are being pushed into poverty, whether it be energy poverty or unable to afford enough food poverty. This may sound a little strange, since despite all of this inflation panic, economies around the globe are expected to see strong economic growth this year. But are there any good things to look forward to? Will this inflation calm down? Diversification, every personal finance guru's favorite word. The current energy crisis is accelerating some countries' push towards having a more diversified energy mix. In Europe, that means nuclear is back on the table, and renewables are being expanded at an even faster rate. This is great news, whether it's natural gas coming from more countries or wind turbines in the North Sea. This will, over time, make Europe, at least, less prone to shocks in energy prices as a result of geopolitics. Just look at France. France has an impressively large nuclear energy industry. For many years, around 70% of its electricity needs have been met by domestic nuclear energy plants. Has this meant that the French have been able to escape the high levels of inflation? Well, no, but it has fared better. Given that the large French energy firm EDF is part owned by the government, it has seen the French state limit the increase in energy prices. As a result, inflation as of March 2022 was significantly lower than similar countries with developed economies. And as countries strive to electrify more of their energy consumption, this could result in more softened increases in the future because of geopolitics or economic shocks if electricity generation is done closer to home. But that's the future. What about now? Well, the current inflation rate is expected to slowly cool down, and here's why. 1. Stability. Uncle Sam has been doing what he does best, rocking up to countries and talking about oil. The US has been looking to stabilize the energy markets. It announced that it will be releasing petroleum from its reserves to help increase supply in the global market. And it's also been signing off on deals to provide some LNG to the EU, as well as toying with the idea of re-engaging with Venezuela to get some of that oil pumping, although none of this is happening overnight. 2. Central banks. The Fed and the ECB, two institutions that pull the levers and press the buttons to more than $35 trillion of global GDP output, have been talking big on raising their respective rates. At the time of writing, the Fed has been talking about raising rates by as much as 75 basis points in order to control inflation. Whereas the ECB has announced it's phasing out of QE in the third quarter. And although it hasn't determined a specific timeline for rate hikes, the market is certainly expecting them to do so. So, what does this all mean going forward? Well, I think it's fair to say that the majority of the increases in inflation are behind us. The measures that central banks across the world's largest economies are taking tell us that inflation is now the #1 target. Personally, I see inflation cooling off and slowly falling in the second half of the year, but it will remain high. COVID supply shocks are sorting themselves out, although China's no-COVID policy is a threat to this. The reversing of monetary policy to go from trying to create demand throughout COVID to now trying to reduce the created demand throughout this phase of high growth and high inflation will take some time. But be assured, central banks are tackling the issue. As for the Russian invasion of Ukraine, well, this will continue to weigh on inflation in the energy and agricultural markets. I'm not going to make a prediction about when it will end, but with monetary policy and COVID supply shocks becoming less of a factor behind inflation, it would be fair to say that even if the war continues, inflation rates should still see a marked decrease, one that should help ease the current crisis on the cost of living. Hey everyone, thanks for watching. Which direction do you see inflation rates heading in before the end of the year? Drop us a thumbs up in the comment section if you think they'll still rise, and a thumbs down if you think rates will cool down. If you want to support the channel, then just check out the channel support box below. Otherwise, take care. Bye.